Hello, everyone, and welcome to our cottage succession recording about Canadian tax implications of cottage succession planning for Canadian and U.S. residents, brought to you by FOCA and featuring estate lawyer Peter Lillico and chartered professional accountant Kaz Nesbitt.
There's a lot of misunderstanding about tax issues and cottage succession issues, and we're hoping that we'll be able to upgrade your level of information so you can make reliable decisions going forward about how best to keep the cottage in the family. We're going to start with capital gains taxes because it's often the most impactful one, and it's probably the one that is most easily misunderstood or misconstrued. And so I'll ask Kaz then to step in and start explaining about capital gains taxes.
Thanks, Peter. Happy to jump in here. So again, referring back to the concept of proceeds of disposition, how do you ascertain value? So let's walk through an example of a capital gain. So we'll start with a cottage that was inherited in 1985 from an individual's parents. Please.
This presentation is intended to explain the tax situation for both Canadian residents and U.S. residents, and although they're similar, there are very important differences between them. The next segment that Kaz and I are going to be speaking about is specifically for Canadian residents. For those U.S. residents who are patiently waiting, I promise you your turn will come because we do have a thorough analysis of the U.S. taxation situation as well.
From there, but there are circumstances and different facts that the Canada Revenue Agency might accept a larger parcel, and those are great examples that you gave.
All right, the next question is, what if I sell to my children at a reduced price? Does that help us to minimize the capital gains tax owed? Does renting your cottage affect capital gains tax?
Now we're going to turn our attention to the Canadian tax considerations that relate specifically to the U.S. residents. So again, I'll ask Kaz to kick it off.
That it is important to file annually as a non-Canadian owner of property to ensure that you get the exemption and that you aren't penalized for not filing. The Canadian government has the right to tax real property before the U.S. government's tax. Finally, we wanted to touch on some other tools. The last piece, which we're going to go into a little bit more detail on further slides, is the concept of a Section 116 certificate of compliance.
So we'll move into some US based questions. I will mention to our listeners that there were some general questions covered in the Canadian Q&A section. For example, how to get a historical valuation of the cottage, what happens if you used your own labor to improve the cottage, and whether that can be used to reduce the overall tax, and selling the cottage to my child at a reduced cost affect capital gains. So I encourage you to jump to the other Q&A section to see some of the answers to those general questions. So does the capital loss apply to U.S. residents with Canadian property? And what Canadian professionals would an American need to accomplish the transfer? Are there any extra fees that would apply being citizens of the U.S. and non-residents of Canada? Why is location of the property a possible exemption for the underused housing tax?